You're about to join into the world of systematic market cycles. Learn the most dependable and consistent, yet often overlooked investment strategy. Welcome to the Technical Intrinsic Value Podcast.
Usually when we talk about getting a medical diagnosis, there's this expectation of clinical precision.
Right. Like it's black and white.
Exactly. You break your arm, the x-ray shows this jagged white line on a black background, and the doctor just points to the math of the bone, right? He just says, there's the fracture, and here is exactly how we fix it. It's visible. It's comforting because the data is just, it's undeniable.
Right. It provides this immediate sense of structural reality. I mean, you aren't guessing about the health of the arm. The physics of the x-ray are doing the talking for you.
Yeah. But then you step into the stock market.
Yeah.
And if you're listening to this right now while commuting or sitting at your desk, you know exactly what I mean.
Oh, absolutely.
You look at your portfolio in this lead cycle environment, and suddenly that diagnostic x-ray machine is it's malfunctioning. You're looking at a landscape that is incredibly murky. Over in one corner, you see this blinding radioactive white light coming from technology stocks. And everywhere else, it just looks like total darkness.
And that blinding light is the absolute definition of diagnostic muddy waters.
Yeah.
Because when one sector emits that much narrative heat, it completely blinds the retail investor to the underlying structural health of the broader economic system.
Like staring into the sun.
Literally. The light creates this illusion of perpetual safety in one area while completely masking these massive opportunities that are, building in the dark.
And tearing away that illusion is our core mission for today. So welcome, everyone. We are doing a very special edition of the show today, functioning as a comprehensive deep dive into the technical intrinsic value methodology.
Which is such a crucial framework right now.
It really is. We are unpacking a stack of incredibly detailed, mathematically rigorous analyses authored entirely by Nicolau Primavera Carvalho. He's the creator of the proprietary technical intrinsic value model, which we'll just refer to as the TIV model from here on out.
Right, and just to be clear up front, all the analysis and forecasting we cover today reflects his views. This is his framework for stripping away all that market noise.
Exactly. And what his research reveals, specifically regarding what he terms the 2026 Energy Supercycle, it's a masterclass in reading the X-ray of the market when everyone else is just staring at that blinding light.
Because the shadows are where the smart money actually operates.
Yeah.
I mean, by the time an asset class is in the spotlight, the largest margins have already been extracted by the institutions.
So if you consider yourself a frustrated intermediate investor, or even, a newer investor, feeling that intense creeping FOMO, that fear of missing out, watching tech stocks completely defy gravity, this deep dive is for you.
Absolutely.
You've been watching the charts wondering if the music is about to stop, feeling the anxiety of holding capital at what might be the top of a cycle. Well, today's about building an emotional firewall. We're going to explore how to stop chasing the spotlight and start positioning your capital where the real institutional wealth is actively being built.
Right. But before we dig into the actual mechanics of this, we really need to set some crucial ground rules.
Yeah, that's a good point. Let's do the disclaimer.
Because in order to thoroughly analyze this 2026 energy supercycle, our sources today deal heavily with some intense real-world geopolitics.
We're talking specifically about the ongoing turmoil and conflict involving the USA, Israel, and Iran, right? As well as domestic energy policies.
Exactly. And we aren't here to debate politics or ideology or foreign policy. That is not what this deep dive is about.
No, not at all. We are strictly looking at the cold, hard math of how these conflicts reroute global supply chains, how they trap oil shipments, and how they force capital to move.
Because the market doesn't vote. It merely measures supply, demand, and risk. So we are impartially reporting on those structural realities as they're presented in Carvalho's analysis.
It's an utterly ruthless discounting mechanism.
It really is. It doesn't care about our feelings regarding a conflict. It only cares about the physical flow of commodities and the mathematical valuation of the companies extracting them.
Okay, so let's start with the biggest psychological hurdle. Because to even understand the 2026 supercycle, we have to talk about recency bias and the fundamental misunderstanding of the S&P 500.
Right.
When the evening news says the market was up today, the average person pictures the S&P 500 as this single giant monolith. Like it's just one big engine powering the American economy.
Which is the primary trap, because the S&P 500 is not a monolith. It's an ecosystem comprising 11 distinct sectors.
Technology, healthcare, energy, real estate, all of those.
Exactly. Think of them as 11 different biological systems within a single body. They operate under entirely different macro environmental pressures. They rarely all fire at maximum capacity at the exact same time.
Right. And you can track the pulse of these specific systems through dedicated ETFs, like the SPDR XL series, so XLK for tech, XLV for healthcare, XLE for energy.
Yes, and Carvalho's analysis points at a profound historical anomaly here.
What decoupling?
Exactly. From mid-2018 up until early 2023, the market ecosystem was relatively balanced. Capital would flow from one sector to another in a pretty healthy rotation. But then June 2023 hit.
Yeah.
And the technology sector, the XLK, achieved complete gravitational escape velocity from the rest of the market.
The decoupling was just violent.
It was. It was driven by the sheer, unadulterated fervor around artificial intelligence, the narrative of these invincible mega-cap tech balance sheets, and the global expansion of cloud computing.
The XLK chart just went vertical, leaving the broader S&P 500 aggregate trailing far, far behind.
And that triggers the recency bias. It's that voice in an investor's head whispering, well, tech went up 40% last year, so it mathematically must go up 40% next year.
Okay, but I'll represent the skeptical listener here for a second. Let me push back.
Sure.
Tech is the future, right?
Yeah.
AI is fundamentally rewriting human interaction with data. It's not just a fad like, Beanie Babies or something. It's a structural revolution.
Yeah.
So why shouldn't a retail investor just park their cash in XLK, ignore all the market noise, and ride the AI wave for the next 20 years? I mean, didn't companies like Amazon and Apple defy cyclical gravity for a decade?
Well, they experienced massive secular growth, yes, but they absolutely did not defy cyclical gravity.
Okay, unpack that.
Think back to the dot-com bubble, or the Nifty 50 in the 1970s. Transformative technology does not exempt a stock from the mathematical laws of valuation. When capital flocks to a specific sector in a late-cycle frenzy, the valuation multiples, which is the price you are paying for every dollar of actual earnings, they become stretched.
Like a rubber band.
Or like a pneumatic system under extreme pressure.
Yeah.
The underlying company might be changing the world, but the stock price is assuming they will conquer the galaxy tomorrow.
The narrative completely outpaces the mathematical ability of the company to generate the required cash flow.
Precisely. And eventually that pneumatic pressure maxes out. And when it does, capital mathematically must rotate.
It has nowhere else to go.
Right. Because institutional money managers cannot justify holding assets trading at 50 times earnings when they can find highly profitable companies in neglected sectors trading at 10 times earnings. They rotate to find alpha. This isn't a glitch in the system. It is the rhythmic, logical breathing of the market.
And, that concept of rhythmic breathing completely reframes how we look at market crashes. Like, let's look at 2008. The popular narrative is that 2008 was sheer, unadulterated chaos. The sky was falling.
To the retail investor watching the news, yeah, it was terrifying chaos. But viewed through the TIV methodology, 2008 wasn't chaos at all.
It was logical.
Entirely logical. It was the brutal but mathematical completion of a massive cycle in the financial and real estate sectors. The leverage had stretched the valuations beyond the breaking point. The cycle had to reset.
And Nicolau Carvalho uses data to remove that subjective bias that makes these events feel so chaotic.
Yes. His framework proves that defensive capital allocation, moving your money into undervalued, essential sectors during the late-stage euphoria of the current leader, is the primary mechanism for wealth preservation.
So surviving the market isn't about setting up some incredibly complex multi-leg options trade to outsmart the algorithms. It's about self-regulation.
Self-regulation and emotional discipline are literally half the battle. I mean, you can have the best mathematical model in the world, but if you cannot control the psychological urge to buy when your neighbor brags about their tech stock doubling, the market will systematically extract your wealth.
You end up buying the top.
Every time. Building an emotional firewall prevents that euphoric buying at the cycle peak and the panic selling at the cyclical trough.
And for anyone who wants to physically understand the architecture of that firewall and how to apply this methodology to their own portfolio, Carvalho lays the entire foundation out in his book, Technical Intrinsic Value.
It's a phenomenal resource.
Yeah, and it's available on Amazon. Do not forget to look that up if you want to understand how to replace panic with actual data.
It essentially acts as a manual for deprogramming the bad habits retail investors learn from financial media.
Okay, so we have established that the AI narrative, while technologically real, has pushed the XLK sector into dangerous valuation territory. The cycle must rotate.
It's a mathematical inevitability.
So the critical question for the TIV investor then becomes, from a top-down perspective, where is the institutional capital quietly migrating to?
Right. And to answer that, the TIV methodology requires that top-down approach.
Yeah.
You never start by picking a random stock ticker you read about on Reddit.
No.
You start from the macroeconomic stratosphere. You analyze sector performance relative to the S&P 500. Then you drill down through specific structural catalysts, demographics, global interest rates, and geopolitics.
Macro to micro.
Yeah.
And the TIV analysis identifies 3 specific sectors currently operating in the shadows of tech, quietly building the foundational architecture for the next decade of outperformance.
Healthcare, real estate, and energy.
XLV, XLRE, and XLE. Let's pull the mechanics of healthcare apart first, because I think it perfectly illustrates how cyclical suppression works.
Oh, absolutely. Right now, XLV is highly unglamorous. I mean, the media focuses purely on political drug pricing debates and regulatory fears.
It's treated like a utility burdened by red tape.
Exactly. But look at the underlying mechanics. When institutional capital anticipates a slowdown in the broader economy or a top in high-growth tech, they seek resilient demand.
And people always get sick.
Healthcare provides demographic inevitability. You have a massively aging global population requiring increasingly complex, personalized medicine. That requires immense R&D capital. During tech downturns, the capital seeking safe, predictable yield flows into these massive healthcare conglomerates.
And the TIV model shows that the bad news surrounding regulation is already fully priced into the current valuation multiples, right?
Yes. The downside risk is structurally capped. It's a very safe harbor.
Okay, now let's pivot to real estate, XLRE, because this is where this skeptical investor is going to start screaming at the dashboard.
And I know.
We've been dealing with a massive hiking cycle. Interest rates have battered the housing market, mortgages are expensive, commercial real estate developers are drowning in refinancing costs. So buying into real estate right now feels less like catching a falling knife and more like trying to catch a grand piano drop from a third-story window.
That fear is entirely logical based on current conditions. I don't blame anyone for feeling that way. But the TIV methodology separates the novice investor from the institutional investor by recognizing one core fact. Markets are forward-looking discounting engines.
They don't care about today.
They do not trade on what is happening today. They trade on what conditions will look like 12 to 18 months from now.
So they are anticipating the turn.
Yes. The TIV model indicates that the market has likely overcorrected for the pressure of high interest rates on the XLRE sector. Extreme negative sentiment, where every headline is forecasting doom for commercial real estate, is historically the precise mathematical bottom of the cycle.
Because everyone who is going to panic sell has already sold.
Exactly. By the time the Federal Reserve officially announces a long-term stabilization or cuts rates, the massive initial surge in real estate equities will have already occurred.
But it's not just about waiting for rates to drop, is it?
Yeah.
There is a massive structural change happening inside commercial real estate that ties directly back to tech.
You're referring to data centers.
Exactly. I look at this phase of the market like a massive theatrical production. The spotlight is shining with blinding intensity on the current star of the show. The AI software companies, the chip designers, the audience in the theater is completely mesmerized by that spotlight.
You're right.
But because that light is so bright, their pupils are contracted. They are completely blind to the fact that right there in the pitch black shadows of the stage hands are quietly, methodically building an incredible, massive, new physical set for the next act.
I love that analogy. It captures the dynamic perfectly. The audience is buying the software narrative, but the stage hands, the institutional capital, are funding the physical footprint required to make the software work.
Because AI doesn't live in the ether.
No, you cannot run an AI revolution in the cloud. The cloud is a physical building. It requires massive tracts of land, specialized cooling architecture, and intense structural engineering. Real estate investment trusts that specialize in data center infrastructure are experiencing a renaissance that is completely independent of residential mortgage rates.
But, and here's the pivot, a data center is just an empty, cold building without one specific thing.
Electricity.
Unfathomable amounts of uninterrupted electricity. And that brings us to the centerpiece of Carvalho's analysis, the most urgent, high-stakes capital shift of our current decade, the 2026 Energy Supercycle.
Energy, tracked by the XLE sector ETF, is the ultimate countercyclical play here. It has suffered from years of structural underinvestment driven by ideological mandates. But in 2026, the macro environment has suffered a collision with physical reality.
To understand the math of this divergence, we really have to look at the geopolitical facts driving the 2026 landscape.
Right.
Because going into this period, the broader consensus was expecting a bearish surplus.
Analysts thought we'd have too much oil, prices would soften, and the energy sector would lag.
Right. But the TIV analysis highlights how geopolitical shocks have completely inverted that reality. We are operating inside the largest structural supply shock since the oil embargoes of the 1970s.
It is historic.
The catalysts outlined in the sources are just stark. The April 2026 Iran war, the targeted infrastructure strikes between Israel and Iran, and crucially, the choking of the Strait of Hormuz. We aren't just talking about a minor delay in shipping here. Over 13 million barrels per day, 13 MBD have been trapped and physically removed from the global export market.
To understand the sheer gravity of that number, you have to consider that prior to this disruption, OPEC Plus had planned to slowly unwind voluntary production cuts of just 1.65 million barrels per day.
Just a tiny fraction.
The global market was finally balancing itself around that tiny fraction. Suddenly, 13 million barrels just vanish. It creates an immediate catastrophic supply deficit that breaks all the standard pricing models.
And the immediate assumption from a novice investor is that other countries will just turn on the taps to fill the void.
Right.
Like Guyana, Brazil, Canada, and they are pumping at record highs. But they physically cannot bridge a 13 million barrel chasm.
No, the infrastructure just isn't there.
Which forces a massive structural shift in international oil trade routes. The USA has violently transitioned into the emergency supplier for the globe. Our sources note that U.S. oil and gas exports have doubled, and in some European and Asian corridors they've tripled, simply to prevent grid collapse overseas.
And this geopolitical shock has triggered a secondary, perhaps more profound shift in long-term industrial investment strategies. We are witnessing the death of the purely ideological green transition and the birth of pragmatic energy security.
Break down the mechanics of that shift for us, because for a decade, global policy has been aggressively pushing carbon neutrality, forcing capital into wind and solar.
And those renewable technologies remain vital for a multi-decade transition. I'm not saying they disappear. But in 2026, governments have slammed into the wall of grid physics.
Intermittency.
Exactly. Renewables suffer from intermittency. You cannot power a modern industrial economy, especially one suffering from the sudden loss of Middle Eastern crude on power sources that fluctuate with the weather. But the ultimate catalyst forcing this pivot to energy security is the AI power crunch.
The data centers we just talked about.
Yes. An AI data center does not operate like a residential neighborhood. It requires what grid engineers call baseload power. It needs a massive, unrelenting, 24/7 stream of high-voltage electricity just to maintain server frequency synchronization and prevent cascading hardware failures.
If a data center loses power for a fraction of a second, the economic damage is staggering.
It's ruinous. You absolutely cannot run that infrastructure on a grid that drops 40% of its capacity when the wind stops blowing.
So ironically, the greenest, most futuristic technology we've ever created, AI, is forcing a massive resurgence in the dirtiest, most traditional commodity markets.
It makes natural gas not just a temporary bridge fuel, but a permanent, foundational industrial pillar for the tech economy. Governments are now aggressively subsidizing domestic fossil fuel backbones because they realize if they cannot physically guarantee uninterrupted electricity, they will instantly lose the global AI arms race.
Let me channel the novice investor again. I hear all of this. I see oil surging well past $100 a barrel because of the Hormuz disruption. Logic dictates that if oil is that expensive, U.S. shale companies should be deploying every drill rig they have. Why aren't there pump jacks popping up in every backyard in the Permian Basin to cash in on this massive gold rush?
It's a great question, and the answer is because the psychology of the U.S. energy sector has fundamentally transformed. During the previous boom cycles of the 2010s, that is exactly what they did. It was the drill-at-all-costs era.
They just flooded the market.
They chased production volume over profitability, flooded the global market with excess supply, and ultimately crashed the price of their own commodity, destroying billions in shareholder value.
So they learned their lesson the hard way.
Brutally so. U.S. shale has evolved into what Carvalho's analysis terms the disciplined giant. Management teams have completely rewritten their compensation structures. They are no longer rewarded for pumping more oil.
What are they rewarded for?
They are rewarded for balance sheet integrity and returning free cash flow to shareholders via dividends and buybacks.
So even with prices sky high, They are refusing to take the bait.
They're showing incredible capital restraint. Despite $100 plus crude, U.S. shale forecasts project only a marginal increase of 250,000 to 500,000 barrels per day in 2026.
That's nothing compared to the 13 million missing.
It's a drop in the bucket. They are running maintenance-level budgets. By refusing to flood the market with unneeded supply, they are mathematically creating a permanent floor under these high prices.
So the macro environment is, frankly, terrifyingly tight. We have a geopolitical war trapping 13 million barrels, an AI revolution demanding infinite baseload power, and U.S. producers rigidly refusing to drill new wells. It's a structural pressure cooker.
A perfect storm.
So how does the TIV methodology actually deploy capital into this without just blindly throwing darts at random oil tickers?
By deconstructing the mathematical inevitability of the Energy Select Sector, SPDR Fund, the XLE ETF, and understanding how its specific components capture different aspects of this pressure cooker.
Let's look at the historical data Carvalho presents. The TIV analysis tracks XLE versus the tech sector, XLK, and the broader S&P 500 from January 2000 all the way to April 2026. The data reveals a distinct rhythmic rotation.
When tech enters its late-cycle distribution phase, when institutional money quietly exits at the top, energy invariably begins its markup phase.
And the mathematical key to this rotation is beta. The XLE ETF has a historically low beta, hovering around 0.50. Now, explain the actual math of beta for the listener, because people throw that term around constantly without really understanding how it functions as a shock absorber.
Sure, beta measures the volatility or the systemic risk of an asset compared to the broader market, which has a baseline beta of 1.0.
Okay.
If an asset has a beta of 2.0, it acts like a lever. If the S&P 500 drops 10%, that asset will likely violently drop 20%.
But XLE's beta is 0.50.
Which means it is structurally insulated. If the broader tech-heavy market experiences a 10% correction due to valuation fears, the math suggests the energy sector will only experience half that volatility. It acts as a massive portfolio anchor.
That low beta, combined with massive free cash flow, makes XLE the premier institutional counter-cyclical hedge right now.
And the near-term catalyst driving capital into that hedge is what the sources call the Hormuz windfall.
Because of the trapped supply.
Right. Analysts are projecting a staggering 71% earnings growth for the energy sector in Q2 of 2026 alone. While the rest of the S&P 500 is watching high fuel costs compress their profit margins, the 22 companies inside the XLE are the ones directly absorbing that exact margin.
To capitalize on that 71% growth, we have to look under the hood of the XLE. It's a highly concentrated ETF. Out of the entire S&P 500, it only holds 22 companies.
And the top 10 holdings dictate 75.7% of the entire fund's weight.
So understanding the ETF requires understanding the specific mechanics of those top holdings. Carvalho breaks the XLE down into 3 engines.
Yes. Engine number 1 is the integrated giants. This is the bedrock of the fund. We are looking at ExxonMobil, comprising roughly 23.5% of the weight, and Chevron at 15.9%.
These two behemoths alone are almost 40% of the ETF. So why are they the bedrock? What makes an integrated giant different from a regular driller?
The term integrated means they own the entire physical life cycle of the molecule. They own the drill bit, pulling the crude out of the Permian Basin, they own the pipelines transporting it, and they own the massive coastal refineries turning it into jet fuel and plastics.
Vertical integration.
Exactly. And this vertical integration provides a fortress balance sheet. When raw crude prices spike due to a conflict, their upstream drilling operations print billions. But if a recession hits and crude prices collapse, their downstream refineries suddenly have incredibly cheap raw materials, allowing their refining margins to expand. They are structurally hedged against their own commodity.
It's like owning the casino instead of playing the tables.
Great way to put it.
But if I'm an investor who knows a massive supply shock is happening, Exxon feels almost too insulated. Where is the leverage? How do investors capture the explosive upside of $100 oil?
That requires shifting to engine number 2. The exploration and production companies, or E&Ps. These are the beta plays. The core holdings here are companies like ConocoPhillips and EOG Resources.
They're pure play operators.
They don't own the refineries. Their entire business model is finding the reservoir, fracturing the rock, and selling the raw molecule.
So their revenue is hypersensitive to the daily price of crude.
Extremely sensitive. If Exxon is the massive, slow-moving shock absorber, the E&Ps are the accelerants. When that severely tight macro environment pushes oil up by $10, these stocks often appreciate at double the percentage rate of the integrated giants.
Because they have zero downstream hedge weighing them down.
Right. And because they are adhering to the new disciplined giant ethos, they aren't wasting that windfall on new drilling. They are piping that cash directly onto their balance sheets.
Then we have engine number 3, the equipment and services companies.
Companies like SLB, formerly Schlumberger, and Halliburton, they don't own the oil. They provide the highly advanced proprietary technology required to extract it.
Because the era of easy oil is dead.
Long dead. You can't just stick a pipe in the ground in Texas and watch it geyser anymore. Producers are being forced into incredibly hostile, complex geological environments, deep water offshore, ultra-high pressure reservoirs.
And they cannot extract that oil without paying a massive premium to service companies for digital twin mapping and advanced reservoir characterization.
The service companies finally have immense pricing power again. And we must include the critical sub-industry within this ecosystem, the midstream companies. Oil and gas storage and transportation.
Companies like Williams Companies and Wanayak. I love looking at these midstream operators through the lens of infrastructure. They are literal toll booths on a massive mandatory highway.
Perfect analogy.
They own the pipelines. They generally do not care if the price of the car, the barrel of oil driving on their highway, is worth $50 or $150. They simply collect a volumetric fee for every single molecule that passes through their steel.
They are incredibly isolated from commodity volatility, making them the most consistent dividend generators in the space.
Now, Carvalho's analysis introduces a fascinating macroeconomic phenomenon affecting all these engines, which he calls the Fed's hawk trap. It is a vital mechanic for investors to understand.
Let's break down the mechanics of the hawk trap. Historically, there is an inverse relationship between interest rates and commodity prices.
Okay.
If the Federal Reserve raises rates, it strengthens the yield of the U.S. dollar. Since global oil is priced in dollars, a stronger dollar usually makes oil more expensive for foreign buyers, reducing demand and driving the price of crude down.
That's the textbook reaction.
But in 2026, that historical correlation is completely broken.
Because the Fed is trapped by the exact commodity they're trying to suppress.
Yes. The Fed must remain hawkish, keeping interest rates elevated to fight sticky inflation. But the primary driver of that inflation is the geopolitical energy shock. Brent crude, sitting at $115, artificially inflates the cost of every single good transported by a diesel truck.
So the Fed keeps rates high to fight inflation, which keeps the dollar incredibly strong. But because the oil shortage is physical, not monetary, the price of oil continues to surge regardless of the strong dollar.
Which creates a phenomenally rare, highly lucrative environment for U.S.-based energy companies. The U.S. dollar and crude oil are rising simultaneously.
Wow.
These U.S. giants are selling their product at globally elevated prices, and they are collecting payment in a currency that is appreciating in purchasing power. It is a dual-engine tailwind that massively inflates their intrinsic value.
It sounds like an invincible setup, but intellectual honesty requires us to examine the bear case. If an investor is committing capital to this super cycle, what are the structural risks that could derail the math?
Carvalho meticulously outlines 3 specific risks that must be monitored. The first is regulatory, the success tax.
Oh, windfall taxes.
Exactly. When energy companies report record-breaking profits while the average consumer is suffocating at the gas pump, politicians invariably respond by proposing windfall profit taxes. This can severely arbitrarily compress profit margins.
A penalty for operating efficiently during a crisis. What is the second risk?
The demand cliff. This is the macroeconomic risk. If the sustained pressure of high inflation and high interest rates finally breaks the back of the global consumer, triggering a severe recession, demand destruction occurs.
Factories shut down, global shipping contracts, people stop driving.
If volumetric demand plummets faster than the supply shortage, prices will crash.
And the third risk involves the dark side of global logistics.
Sanctions leakage and the shadow fleet. Even though 13 million barrels are physically blocked or politically sanctioned, a massive black market exists.
A shadow fleet of aging tankers operating with deactivated transponders, constantly moving illicit oil from sanctioned nations to willing buyers.
If this shadow fleet becomes too efficient, it secretly bleeds massive amounts of supply back into the global market, softening the pricing floor.
Those are significant risks. But the TIV framework concludes that currently, the structural grid-level necessity for baseload power to feed the AI revolution far outweighs the probability of a demand cliff. We are existing in a moment of maximum structural tension.
And to truly grasp how to trade that tension, we need to move from theory to application. We need to look at how Carvalho used the TIV model to target a specific entry and exit point.
And the sources provide a perfect case study. EOG Resources, ticker symbol EOG. We established earlier that they are an E&P, a pure-play driller, operating in the Permian and the Eagle Ford.
Yeah.
High-leverage beta play.
They are a $67 billion behemoth that perfectly encapsulates the disciplined giant ethos. Massive operational efficiency, combined with an impenetrable balance sheet.
And for full transparency, drawing directly from our sources, Nicolau Primavera Carvalho actually holds EOG stock in his own portfolio. He executed a purchase of EOG on December 20th, 2024, at an entry price of $128.26.
And as of the writing of the analysis we're reviewing, the stock had appreciated to $133.13.
He doesn't just theorize, he deploys capital based on his own mathematical framework. And his analysis of EOG reveals the true predictive power of the TIV methodology because it relies on market geometry.
Market geometry. This is where we leave traditional fundamental analysis behind.
Walk us through the psychology and the mechanics of the five-wave structure.
The five-wave structure is the foundational architecture of technical trend analysis, refining the principles of Elliott wave theory. Market trends do not move in straight lines. They breathe. They move in psychological waves driven by greed, fear, and capital flow.
Let's break down the psychology of each wave. Let's start with wave one.
Imagine an asset that has been brutalized by negative sentiment. Wave one is the initial, almost imperceptible upward thrust. This is driven by deep value, contrarian institutional investors.
The smart money stepping in early.
They are stepping in to buy when everyone else is terrified, recognizing that the fundamental downside is exhausted. The price ticks up.
But the broader market doesn't believe it yet.
Right, which triggers wave two. The early buyers take a quick profit, and the remaining weak hands panic and sell. The price drops sharply, but crucially, the underlying math of the contrarian buying prevents the price from dropping below the original starting point. It sets a higher low.
The pneumatic pressure is building.
And then the dam breaks. Wave three. This is historically the longest, most violent, and most profitable phase of the market cycle. The algorithmic momentum scanners trigger. The broader institutional market suddenly realizes the macro fundamentals have shifted. Capital violently rotates into the asset. It is a massive, sustained surge.
Eventually, that momentum exhausts itself.
Leading to wave four, a period of choppy, sideways consolidation. Institutions lock in their wave three profits, and the market digests the new valuation.
And the final act. Wave five.
The fundamental structural catalysts are actually starting to weaken by this point, but the asset has been going up for so long that the financial media is finally talking about it nonstop.
This is where recency bias infects the retail investor.
They suffer massive FOMO and flood into the stock. Wave 5 is driven entirely by retail euphoria, not institutional math. And the completion of that fifth wave mathematically signals the absolute top of the trend, usually followed by a devastating, prolonged correction.
So applying that architectural framework to EOG Resources, where exactly does the TIV model place EOG right now?
Based on Carvalho's geometric charting, EOG is currently sitting dead center in the middle of Wave 3, the institutional surge.
From the analyzed price of $123.78, the TIV model projects a mathematical, targeted upside of 94%, aiming for the exact top of Wave 3 at $239.70.
That's the target.
Wait. I need to stop and push back on the timeline here, because this is where the skeptical investor's brain just short circuits. We spent the first half of this deep dive outlining how the April 2026 Iran war and the 13 million barrels trapped in the Strait of Hormuz are the physical catalysts forcing oil prices higher. But Carvalho's analysis clearly states that this $239.70 price target for EOG, based on the five-wave geometry, was defined well in advance of the turmoil between Israel and Iran.
It was defined months before the specific geopolitical event occurred.
How is that physically possible? How can a mathematical model draw a line on a chart to $239, an explosive target that inherently requires a massive geopolitical supply shock to achieve before the first missile is ever fired? Are we claiming the model predicts the future,
We are claiming something much more profound. This is the absolute core revelation of the TIV methodology. The model completely ignores CNN. It ignores geopolitical noise. It ignores news headlines.
Because the news doesn't create the tension.
Because the news does not create the structural tension. The news merely acts as the spark that ignites tension that is already mathematically visible in the price action.
Unpack that. How is tension visible in a chart?
Institutional money, sovereign wealth funds, massive endowments, they operate with billions of dollars. They cannot hide their movements. When they spend years structurally underinvesting in global energy infrastructure, they know a supply crunch is an absolute mathematical inevitability.
They start positioning.
They begin quietly positioning their capital in wave 1 and the beginning of wave 3. This massive accumulation of capital leaves an indelible geometric footprint in the volume and price structure of the asset. The 5-wave geometry was tracking the accumulation of capital, preparing for a systemic supply deficit.
So the math was already demanding an explosive move upward. The structural deficit was already priced into the geometry. The conflict in Hormuz just happened to be the specific, random physical vehicle that delayed the inevitable outcome.
Exactly. If it wasn't a conflict in Hormuz, it would have been a catastrophic refinery failure or an unprecedented winter freeze. The tension had to break. And this definitively proves why retail investors must learn to track cyclical mechanics rather than reacting emotionally to news alerts.
Because if you wait for the news, it's too late.
If you waited for the news of the 2026 war to break before buying XLE, you completely missed the foundational Wave 1 and Wave 2 entries. You are buying the news, which is when the institutions are starting to sell to you. By focusing purely on geometric structure, Carvalho identified the massive discrepancy between EOG's intrinsic value and its stock price long before the news provided the catalyst.
That concept that the math predicts the tension before the news delivers the spark is staggering. And for listeners who want to actually master this, who want to learn how to read the geometric X-ray of the market and strip the emotion out of their capital allocation, there's a very specific avenue to do so.
Yes, the mentorship program.
Miquel Carvalho offers the Technical Intrinsic Value Program. But I want to be extremely clear about what this is. This is not a massive automated online course where you watch generic videos. It is a highly exclusive, intensive mentorship program. He strictly limits enrollment to a maximum of 5 students at any given time.
And that limit isn't an artificial marketing tactic. It is a psychological necessity.
Explain why.
Because teaching someone the mechanics of the 5-wave geometry is only 10% of the battle. The other 90% is intense, personalized psychological deprogramming.
Calling the firewall.
Carvalho has to work directly with those 5 individuals to actively strip away years of recency bias, media conditioning, and emotional panic. You cannot achieve top-to-bottom mastery of the TIV model in a crowded room. It requires absolute, high-integrity, one-on-one focus.
If you are ready to stop guessing, stop letting the financial news dictate your anxiety, and start understanding market cycles at an institutional level, you need to get in line. Direct yourself to www.technicalintrinsicvalue.com and join the waiting list for the mentorship program. Again, that is www.technicalintrinsicvalue.com.
It is the ultimate tool for building that emotional firewall we've been talking about.
Let's synthesize this massive journey we've taken today. We started by diagnosing the fundamental illness of the retail investor, recency bias, the desperate, FOMO-driven urge to chase the blinding light of the technology sector just as the cyclical pneumatic pressure is reaching its breaking point.
We replaced the fear of 2008-style chaos with the cold mathematical logic of top-down sector rotation. We mapped how institutional capital is actively building the next decade of foundational wealth in the shadows of healthcare, real estate, and energy.
We deeply analyzed the mechanics of the 2026 Energy Supercycle. We moved past the headlines of the 13 million barrels trapped in Hormuz and uncovered the permanent structural demand for natural gas baseload power required by the AI revolution.
And how the disciplined giants of U.S. shale are permanently elevating the price floor.
We deconstructed the engines of the XLE ETF, and finally, we proved through the EOG case study how the 5-wave geometry mathematically anticipates the news cycle rather than reacting to it.
The ultimate takeaway for you, the investor feeling the pressure of this late cycle environment, is that your greatest weapon is not discovering a secret stock ticker.
Your greatest weapon is a disciplined emotional firewall. Prioritize defensive capital allocation. Stop playing a chaotic game you don't fully understand, and start mathematically aligning your capital with the inevitable rhythm of the cycle. And again, if you want the blueprint for this entire methodology, go to www.technicalintrinsicvalue.com and secure your copy of Nicolau Carvalho's ebook, Technical Intrinsic Value.
It will change the way you view every flashing red and green number on your screen.
To close this out, I want to leave the frustrated intermediate investor with one final provocative thought to mull over. It brings us right back to our opening metaphor about reading the diagnostic X-ray of the market.
If the geometric footprint of institutional capital tracked through the five-wave structure was mathematically capable of predicting a massive 94% upside in energy equities months before the first missile was fired or the first oil tanker was blockaded in the Middle East, we have to ask ourselves a profound, almost philosophical question about how the world actually works.
Does the news cycle actually drive the financial markets? Or does the inevitable mathematical tension of the market cycle simply wait for the news to fulfill its geometric destiny?
Let that concept sink in.
Thank you all for joining us on this deep dive into the technical intrinsic value methodology. Stay disciplined, build your emotional firewall, trust the math, and we will see you next time.
That's it for today. I'll see you in the next episode. The Technical Intrinsic Value Podcast is a systematic exploitation to enhance data analysis and delivery. All content logics provided herein are a direct reflection of the opinions value modeled Nicolau Primavera Carvalho. The information provided is for educational and informational purpose only and does not constitute financial, investment, or legal advice. The TIV model is a framework designed to identify patterns based on 15 years of future results. All investments involve risk. By continuing, you acknowledge you are a self-reliant investor responsible for your own execution.